Hello and welcome back to the American Dream Portfolio. Here's a most important question for every investor. What might cause you to sell your investment at a loss? By loss, we mean a meaningful loss. If you own $10,000 worth of Apple stock and you sell one share at a $3 loss, that is not meaningful. But if you sell your entire position at a $3,000 loss, well, that's meaningful. In this video, we continue our analysis of investment risk, which we defined as the likelihood that you would sell your investment at a loss. We are not talking about paper losses. We are talking about money that has irretrievably disappeared from your account because you traded it away. But let's not be too hard on ourselves. Instead, let's ask the question, what might cause you to do that? Aside from the desperate need for money, let's consider the fundamental reasons. We began a discussion of the first reason in our last video, but we'll dig deeper into it here. That reason is a misunderstanding of how your investment grows in value. In previous videos, we said an investment can grow by compounding, by appreciation, or by both mechanisms. But in continuing our analysis, we have discovered an error in this conclusion. Let's identify that error now and see how it relates to investment risk. Despite what we previously stated, investments that grow by appreciation cannot also grow by compounding. Why not? Because appreciation is inescapably linked with depreciation, or a loss in value. They are joined at the hip. Assets that go up in value also go down, but as we saw in the last video, compounding results in an ever-increasing account value. It cannot go down. And throughout the compounding process, the underlying asset, whether it's a bond or savings deposit, stays fixed in value. The account rises in value only because of compound interest, not because of an increase in the value of the underlying asset. How does this error relate to investment risk? Well, it misleads investors into thinking that their investments in appreciating assets like stocks, real estate, and gold can compound their way to higher values. They cannot. Instead, these assets appreciate their way to higher values, if they go up at all, and what goes up must also go down. So it's problematic that the word compounding has such a reassuring meaning. It may lull investors into thinking that growth will automatically occur if they just give it enough time. But growth in these assets cannot be guaranteed as it can be with compounding. We, too, were caught in the trap of misunderstanding the compounding mechanism until, after further analysis, we realized our error. If the truth be told, the only investments that genuinely compound are interest-bearing investments such as bank accounts and bonds that are either held to maturity or that are purchased directly from and sold directly to the bond issuer, as is the case with US savings bonds. More on bonds in a future video. Gold certainly can't compound because it doesn't produce income, but what about dividend-paying stocks? Don't they compound? If the investor plows those dividends back into the account, doesn't that work like compound interest? No, it does not. Dividends are not interest. Dividends do not represent new money added to the account as interest does. Remember in an earlier video we talked about dollars sticking to a money ball as it rolls down a mountain. Those sticky dollars came out of nowhere and were added to the money ball. That's how interest and compounding work. Dividends aren't like that. Recall that a dividend represents company profits that are shared with the stockholders. As such, dividends are taken from the value of the company and given to you as cash. In the money ball analogy, a dividend comes from peeling a chunk of value off the money ball and giving it to you as cash. If you have a $10 cash dividend in your hand, your money ball has shrunk by those same $10. No new dollars were added, they were just rearranged. That's not compounding. Although, as we saw in a previous video, if you reinvest dividends, you can expect a better long-term result, but that is because you are leaving the money invested, so it can work for you as it is able to through appreciation, not because of compounding. How about real estate? Can real estate compound? After all, rent, unlike dividends, does represent new money, but, as with stocks, the underlying asset, real property, fluctuates in value. The rental income may stick to the real estate money ball, but that ball sometimes shrinks and sometimes expands rapidly, regardless of the added rent. That's not compounding. And so, to be clear, Assets that appreciate, like the S&P 500, do not compound at some long-term average rate. They don't compound at all. Instead, they vacillate their way between appreciation and depreciation and give you a final unpredictable result. Investors who anticipate a comforting and inexorable compounding machine that leads to financial independence may be bitterly disappointed, and that disappointment may prompt them to sell their investment at a loss. A second fundamental reason for selling at a loss is when an investor's ultimate goal is to be right rather than to make money. What do we mean by this? Don't all investors want to make money? Presumably, they do, but consider this example of the need to be right. Let's say you are a big fan of McDonald's. You've been indulging in Big Macs since you were in high school, and now your kids love Happy Meals. You came into some money through an inheritance, and now you want to put it to work. So, you read a few books on investing and watched a few videos besides. One of the common themes seemed to be, invest in what you know. This sounds reasonable. You know McDonald's inside and out, but only as a customer. You decide to dig deeper. You're no accountant, but you understand basic arithmetic. With company information so readily available these days, you start investigating McDonald's financial prospects. You pore through data on the company's sales, profits, cash flow, debt, balance sheet, etc., etc. But today's numbers don't tell the whole story. So, with help from various sources, you project today's financials into the future. Not just to next year, but to 5, 10, even 20 years into the future. Everything looks good, but you realize you're not done yet. What about McDonald's senior management? Can they successfully lead the company into the future? How strong is McDonald's economic moat, that suit of armor that is very difficult for competitors to break through? You dig into these topics with a vengeance when you finally complete your exhaustive analysis. All of your data, all of your projections, and all of your reasoning is distilled into one incredibly useful number: the intrinsic value of one share of McDonald's stock. This number tells you what McDonald's is actually worth today, or so you think. Your number is $365 per share. You look up McDonald's closing price for the day. Only $305 per share. Well, the market has undervalued McDonald's stock by $60 per share. It's a no-brainer. The market will come around to your way of thinking eventually. Just give it time. You decide to jump in with both feet and buy 1,000 shares. That puts you immediately ahead by $60,000. You can't lose. I think we can all agree that this investor has more than just money invested in McDonald's. He has his pride, his ego, and his unshakable belief that his reasoning can't be wrong. Whether he realizes it or not, he is primarily in the market to prove that he is right. But that will not happen until McDonald's stock shows him a handsome profit. If it ever does. Do you think it's possible that McDonald's stock might turn sour for any number of reasons, and that this investor will stubbornly hang on, convinced that he is right, until the paper loss becomes too great to bear? When he finally capitulates, it may be at a substantial loss. This scenario is probably repeated thousands of times every day. At the American Dream Portfolio, our primary purpose is to make money and to show you how to do so, not to be right. Beginning with the next video, we continue our discussion of investment risk by looking at 4 emotions that can jeopardize your financial security. See you then.